Every person alive today is part of an experiment they never signed up for. A century-long transformation of money, debt, and savings, constructed slowly, defended fiercely, and refined over generations. And even if you've never studied economics, you've felt the consequences. Your paycheck goes up, but somehow buys less. Your savings account balance grows, but its power shrinks. Housing prices soar faster than wages. Retirement feels like a moving target. And every time the economy starts to wobble, the same remedy is applied. More debt, more liquidity, more inflation. We are told this is normal. We are told this is healthy. We are told inflation is simply part of growth, something to accept, not question. But inflation is not a natural law. It is not gravity. It is not inevitable. It was built not by one mastermind, not by a hidden cabal, but by four groups of thinkers and decision-makers: philosophers, financiers, regulators, and policymakers, each trying to solve the problems of their time. And accidentally constructing a system where saving becomes self-destruction and debt becomes the engine of economic survival. These architects never met as a committee. In fact, many of them fought bitterly, publicly, academically, but their ideas interlocked like gears in a machine. One idea turned and it pushed the next. Each solution created new incentives. And together, they formed a mechanism that funnels purchasing power upward, transforms national debt into perpetual profit, and leaves households bearing the hidden cost. This video is the story of how that mechanism was built. No speculation, no conspiracies. Just documented history, published papers, public legislation, and the actions of institutions that shape your daily financial life. We'll trace the path from the intellectual war between John Maynard Keynes and Milton Friedman, to the rise of Wall Street's debt alchemists, to the regulatory choices that dissolved the final guardrails. And once you understand these forces, one truth becomes impossible to ignore: inflation isn't a mistake. Inflation is the business model. Architect 1, the philosopher Keynes-Friedman. For centuries, money was anchored to finite resources, most famously gold. This tether meant governments couldn't spend freely or borrow endlessly. It limited inflation, it restrained politics, and it forced recessions to resolve through painful, yet temporary adjustments. Then came the catastrophe of the Great Depression. By 1936, after years of collapsing markets, mass unemployment, and worldwide despair, British economist John Maynard Keynes published one of the most influential works in economic history: The General Theory of Employment, Interest, and Money. Keynes argued something radical: markets could break and stay broken for long periods. And in those moments, the only actor powerful enough to restart the engine was the government. His message was clear: spend, borrow, stimulate demand, and yes, accept short-term inflation if it helps revive the economy. This became the foundation of what would later be called demand management. Keynes was not advocating unlimited spending or permanent inflation, far from it. But he gave governments a powerful political tool: the ability to spend their way out of crisis and to justify that spending economically. After World War II, much of the world embraced these principles. The 1944 Bretton Woods Agreement built a new monetary structure centered on stability, cooperation, and government responsibility for employment and economic growth. For a time, the system worked. Growth was strong, living standards rose, inflation stayed moderate. But by the late 1960s and early 1970s, the world changed. War spending increased. Oil shocks rattled global markets. And in 1971, the United States ended the Bretton Woods gold convertibility, breaking the final tie between the dollar and gold. A new crisis emerged: persistent, rising inflation. And in the middle of this chaos stepped a new intellectual force: Milton Friedman, the leading voice of the Chicago School of Economics. In his landmark 1967 speech as president of the American Economic Association, Friedman delivered a message that would reshape global policy: inflation is always and everywhere a monetary phenomenon. If inflation was rising, it was because the money supply was growing too fast. The solution: control the money supply, limit discretion, and trust markets. His ideas spread rapidly, politicians embraced them, central banks adopted them. Friedman argued for disciplined, predictable monetary growth and, in doing so, helped legitimize the idea that low, steady inflation could be acceptable. And this is the twist. Even as Friedman opposed high inflation, his framework implicitly allowed for permanent, managed inflation so long as it was stable and moderate. He also introduced the concept of the natural rate of unemployment, arguing that trying to push unemployment too low would only cause more inflation. This philosophy gave central banks a new mandate: prioritize inflation control even if it meant accepting unemployment. So the two great intellectual architects of the 20th century, often portrayed as opposites, ended up creating a combined legacy. Keynes gave governments the moral license to intervene, to borrow, and to use inflation in emergencies. Friedman gave central banks the intellectual license to permit mild, continuous inflation as the price of stability. They never intended to build a system of perpetual debt. They never envisioned decades of deficit spending. They didn't predict the financialization of the entire economy, but their ideas unlocked the door. And as the 1970s ended and the 1980s began, someone else walked through it. Wall Street, architect too. The financier. By the 1980s, a fundamental transformation was underway, one that would redefine global finance. Debt, which had always been a burden, suddenly became a product. This shift wasn't invented by one person, but one figure became the icon of this revolution: Michael Milken, the financier who popularized high-yield corporate bonds, better known as junk bonds. Working at Drexel Burnham Lambert, Milken saw something few others recognized. Companies with lower credit ratings were charged extremely high interest rates because lenders feared they would default. But historically, many of these companies survived, grew, and repaid their debts. Milken realized that if investors pooled these bonds, diversified the risk, and demanded higher yields, they could outperform traditional investments. It was a breakthrough, not yet the world of exotic derivatives or subprime mortgage bets, but the beginning of a new financial logic. Debt could be packaged. Debt could be sold, debt could be traded, debt could be transformed into profit. Throughout the 80s and 90s, financial innovation accelerated. Firms like Salomon Brothers pioneered mortgage securitization. Figures like Louis Ranieri helped turn home loans into tradable securities, collateralized mortgage obligations, or CMOs. The mechanism was elegant. You take a steady stream of payments, mortgages, credit cards, auto loans. You pool them, you carve the pool into slices with different risk levels, and you sell those slices to investors around the world. Debt became the raw material for a booming financial industry. But the second-order effect was even more important. The financial sector became dependent on the continuous creation of new debt. If households borrowed less, the machine slowed. If governments cut deficits, asset pools shrank. If cash flows weakened, fees, profits, and bonuses all collapsed. Markets needed debt the way engines need fuel. By the late 1990s and early 2000s, the industry evolved yet again. Derivatives arrived. Credit default swaps, popularized by firms like AIG Financial Products, allowed investors to insure debt, bet on debt, and multiply exposure to debt without creating new loans. Synthetic collateralized debt obligations magnified everything further, turning small pools of loans into vast webs of leveraged bets. Debt wasn't just a tool, debt wasn't even just a product. Debt became the lifeblood of the modern financial system. And when debt becomes the lifeblood, inflation becomes essential. Because inflation increases nominal cash flows, higher home prices lead to bigger mortgages. Bigger mortgages create larger securities, and larger securities create more profit. The financiers pioneering these instruments weren't trying to hurt savers. They were chasing yield, efficiency, and innovation. But their success required a world where credit never stops flowing, asset prices trend upward, inflation never fully goes away. The machine was built. But it still had one problem. There were guardrails, laws, and regulations left over from earlier decades designed to prevent exactly this kind of explosive financial expansion. And those guardrails were about to come off. Architect 3, the regulator for most of the 20th century, one law shaped American finance, the Glass-Steagall Act of 1933. Created in the depths of the Great Depression, it separated commercial banking, ordinary deposits and loans, from investment banking, trading and securities issuance. The logic was simple. If banks were allowed to gamble with depositor money, the entire financial system could collapse. For decades, this separation kept risk contained. Banks lent money, investment firms traded securities. The wall between them was firm, but by the 1980s and 1990s, the political mood shifted. Deregulation was in vogue. Policymakers believed competition and innovation were being held back. Big banks wanted to expand, markets wanted consolidation. The result was historic. In 1999, Congress passed the Gramm-Leach-Bliley Act, which effectively repealed key parts of Glass-Steagall. Commercial banks, investment banks, and insurance companies could now merge into financial conglomerates. Institutions became larger, more complex, and far more interconnected. 1 year later, the Commodity Futures Modernization Act of 2000 arrived. This legislation exempted many over-the-counter derivatives, including credit default swaps, from regulation. These were not secret policies, they were public, debated, and signed into law. But they transformed the financial landscape. Banks could now use depositor money for trading. Leverage could rise dramatically. Securitization could expand without restraint. Derivatives could flourish in the shadows. This created what economists now call the shadow banking system, a vast network of financial activity outside traditional supervision. This new legal environment didn't cause inflation directly, but it created the amplifier that made inflation essential. Because when banks, hedge funds, and insurance giants rely on rising asset values, when their profits depend on new loans, new securities, and new derivatives, when the system itself requires constant credit expansion, inflation becomes structural. After the year 2000, this dynamic only strengthened: the dot-com crash, the housing boom, the 2008 financial crisis, the European debt crisis, the COVID-19 shock. Each crisis triggered more intervention, more liquidity, and more tolerance for inflation. Regulators did not intend to create a system that punishes savers. Their goals were modernization, stability, and global competitiveness. But the consequences were unmistakable. Housing affordability collapsed as mortgage-backed securities drove up prices. Savings accounts lost value because central banks targeted positive inflation. Governments depended on deficits to stabilize economies. Financial institutions grew larger, more interconnected, and more dependent on rising nominal asset values. Three architects had now built the foundation: the philosophers who legitimized intervention, the financiers who monetized debt, the regulators who removed the constraints. Only one thing remained: the mechanism that ties it all together. At the core of modern inflation lies a hard truth: someone must always be paying interest. Households, corporations, governments, someone must borrow continuously, so the financial system has assets to package, trade, and leverage. This creates a four-step cycle. First, governments run deficits, issuing bonds to stabilize the economy. Second, central banks maintain mild inflation, reducing the real burden of that debt. Third, financial institutions package and trade the debt, turning obligations into assets. Fourth, households absorb the cost through higher prices and declining purchasing power. Every actor behaves rationally. Governments avoid recessions. Central banks manage debt burdens. Financial institutions chase yield. Households try to save, yet their savings erode. This is why inflation persists. This is why debt grows faster than GDP. This is why asset prices soar while wages struggle to keep up. It isn't a conspiracy, it's a structure assembled over a century, one idea at a time. Keynes offered governments the rationale to intervene. Friedman offered central banks the framework to institutionalize mild, permanent inflation. Milken and Wall Street turned debt into the engine of financial markets, and regulators provided the legal environment for infinite scale. And today, all of us live inside the machine they created. Understanding this structure is the first step in escaping it. Because once you see that inflation is not a glitch and not an accident, you can finally understand the financial world as it truly functions. Inflation is not the fire, inflation is the fuel, and the engine it powers is the global economy itself. Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.